Welcome to the Deep Dive, your express lane for understanding the key insights from today's financial world.
Glad to be here.
Today, we're really getting into the Q1 fiscal year 2026 earnings for Casey's General Stores. You know them, NASDQ ticker KCY.
Right, Casey's. Convenience store giant, big focus on prepared foods.
Exactly. So we've combed through the earnings call, looked at the numbers, what management said, how the market reacted.
And our job today is basically to give you the clearest picture of where they stand and maybe what's coming down the pike.
It was, well, kind of a fascinating quarter, wasn't it?
It really was. Because, I mean, on paper, the results look undeniably strong, like really strong.
But the market reaction, bit different.
Yeah, a little muted maybe.
Right.
Hinting at maybe a disconnect we should probably dig into.
That's the mission for you today. Let's understand that disconnect. So let's kick off with the headline numbers, because Casey's really did put up a strong first quarter.
They certainly did. GAAP diluted EPS, that came in at $5.77.
Wow, that's 19% up year over year.
19%, yeah. And it significantly beat the consensus estimates. Those were hovering around, what, $5.01 to $5.03. So a big beat.
Okay, so bottom line, way better than expected. What about the top line? Revenue.
Same story there, really. Total revenue hit $4.57 billion.
Which is up 11.5% from last year. Also above consensus, right?
Comfortably above. Consensus was more like $4.48 billion to $4.53 billion. So, yeah, revenue and earnings both beating expectations pretty handily.
Strong beats, no doubt about it. And EBITDA, that climbed too.
Yep. EBITDA was around $414 million. That's up about 20% year over year. Net income landed at $215 million.
So, I mean, almost every key metric looks incredibly healthy.
Right, which makes the market reaction kind of puzzling.
Exactly. Despite these really stellar figures, market enthusiasm was, well, surprisingly muted. The stock actually pulled back a bit.
That is the paradox, isn't it? You see numbers this good, you usually expect a nice jump in the stock price. So this sort of tempered reaction, it suggests investors might be looking past Q1, maybe thinking about future guidance, or maybe those integration challenges we'll get to.
Could be that classic sell the news thing, even when the news is good.
Feels a bit like that, yeah. So let's peel back the layers, figure out what fueled these results. Where should we start? Inside the store.
Sounds good. That's where a lot of the action is for Casey's. Inside sales were up a very healthy 14.2% year over year, hit $1.68 billion.
And the same store numbers, which tell you about the core business health, right?
Yeah, the really important ones.
Inside same store sales grew 4.3%. And get this, that's a 6.7% two-year stack.
Okay, so consistent strength. What about margins inside?
Still impressive. Gross margin held at about 41.9%. It's pretty remarkable how they're balancing that volume growth with profitability like that.
Now, here's where it gets really interesting for me. Prepared food and dispensed beverages, always a focus for them.
Oh, yeah. Huge differentiator. And they were a standout performer again this quarter.
I'll stand out.
Led the way. 5.6% jump in same-store sales. That's a fantastic 10.2% on a two-year stack.
Wow. And the margins there must be good?
Staggering, really. Around 58% gross margin.
58%. Okay.
Well, management pointed to innovation, good promotional activity, and critically, a better mix. More whole pizza sales, more bakery items.
And those are their highest margin things, right? So that mix shift is gold.
Exactly. It's like a masterclass in managing that category. And it wasn't just prepared foods either. Grocery and general merchandise, that saw same-store sales rise too.
How much?
3.8%, or 5.4% on a two-year stack. And again, margins expanded there too.
Why was that?
Same story, really. Favorable mix shift towards higher margin stuff. The energy drinks, nicotine alternatives, things like that.
Gotcha. And they mentioned traffic. More people coming in.
Yeah, positive traffic growth driven by their summer merchandising, which is, always what you want to see in retail. More feet through the door, not just bigger baskets.
Traffic growth is always a good sign. Okay, let's switch gears. What about the other side? Fuel. That can be volatile.
It can be, but Casey's managed it well this quarter. Same-store gallons sold were actually up 1.7%.
Okay, 1.7% up. Is that good?
It's actually really good when you consider the broader mid-continent region, where gallons were down about 3%.
Ah, okay. So they're definitely taking share then.
Clearly. Significant market share gains. And they didn't have to slash margins to do it.
What was the fuel margin?
Remained strong, over 40 cents a gallon, specifically 0.41 cents per gallon.
41 cents. Okay, so they're balancing volume and profit there too.
Exactly, striking that tricky balance. And we also saw some progress on their Fuel 3.0 initiative.
Right, that's their strategic sourcing program.
Yeah, basically trying to optimize how they buy fuel, diversify sources, leverage market stuff. About 8.8% of total fuel was procured this way for the combined business.
Combined meaning includes the acquisition.
Right. It's heavily weighted by the Fikes acquisition they did. The base Casey's business is only around 3% procured through Fuel 3.0 right now.
Okay, that's an important distinction. So smart sourcing happening. What about costs, operating expenses? How are they managing the engine room?
Well, on a same-store basis, excluding credit card fees, OPEX increased 3%.
What drove that?
Mainly some modest wage increases. But, and this is clever, they partially offset that by cutting back on training hours and overtime. So same-store labor actually decreased by 1%.
Interesting. Managing labor well, but total OPEX was up more, wasn't it?
It was. Total operating expenses jumped 14.6%. But here's the key thing. About 10% of that increase was just because they're operating more stores.
Ah, the unit growth. How many more stores?
221 more stores compared to last year. So a big chunk of that OPEX increase isn't cost creep, it's just the cost of getting bigger.
Makes sense. They're managing the core costs while expanding. Anything else on expenses? Tax rate?
Yeah, it's small positive there. The effective tax rate was 22.7%, down a bit from 24.1% last year, mostly due to some increased tax benefits from share-based awards.
Okay. Solid execution on expenses. Now, how are they using their cash? Capital allocation, dividends.
Steady as she goes on the dividend. The board kept the quarterly payout at $0.50 per share, signals commitment to returns.
And buybacks. Still active there.
Yep. They bought back about $31 million in shares during Q1, and they still have $264 million left on their current authorization. So plenty of firepower there.
Financially, they sound pretty solid then. Debt levels.
Very healthy. Debt to EBITDA ratio is conservative, about 1.88 times. And they generated a ton of cash.
Free cash flow.
Impressive. $262 million in free cash flow this quarter. That's up quite a bit from $181 million last year.
Right.
So plenty of cash for growth or more shareholder returns.
Strong financial discipline showing through.
Yeah.
Okay, let's talk about a big piece of the puzzle and maybe part of that market caution we talked about, the CEFCO Fikes acquisition.
Right. That closed back in November 2024. Big deal.
Big.
Added almost 200 stores. 198, I think. Including 148 in Texas, which is a newer market for them. Plus, it brought in a fuel terminal and a Texas commissary.
Sounds like a massive integration job.
It absolutely is. And it's having a noticeable impact on the numbers right now.
A negative impact.
Yeah, bit of a drag, honestly. It pulled down the prepared food margin by about 110 basis points this quarter.
Ouch.
And it also nudged the fuel margin down by about 1.5 cents per gallon. Basically, these new stores, they aren't yet running at the same profitability level as the established Casey's stores.
Why not?
Well, management's working on it, adjusting the product mix, promotions. But the real win comes when they convert the kitchens in those acquired stores to the full Casey's model.
The pizza ovens and everything.
Exactly.
Yeah.
And that takes time, permits, construction. It's not instant.
So these acquired stores, especially the Texas ones, aren't fully Casey's-ified yet. They don't have that high-margin food offering fully rolled out.
Precisely. They're not yet delivering the full Casey's value proposition, so they're dragging the overall margins down a bit for now. It's a classic integration headache.
Is there any good news on the integration front?
Actually, yes. They mentioned that early synergy capture is running ahead of schedule, particularly on the fuel side and in G&A savings.
So they're finding efficiencies faster than planned.
Seems like it. The overall synergy target was, $45 million? They still think that's achievable and maybe even beatable once those kitchens are fully remodeled and humming.
Okay, so short-term pain for potential long-term gain on that acquisition. It's a marathon, like you said.
Definitely a marathon, not a sprint.
All right, that gives us a much clearer view of Q1. So what does this all mean for you, the investor, looking ahead? Let's get into that broader context, starting with their outlook. Did they change guidance?
No, and this is really the crux of that market reaction we discussed. They reiterated their full-year fiscal 2026 guidance.
Remind us what that was.
EBITDA growth of 10-12%. Inside same-store sales growth of 2 to 5%. Inside margin around 41%. And same-store fuel gallons somewhere between down 1% and up 1%.
So basically, steady state, no raise after the strong Q1 beat.
Exactly. And that unchanged guidance seems to be the key reason for that sell-to-news response. I think many investors were probably hoping for, or maybe even expecting, a guidance raise.
But management didn't bite.
No. They specifically talked about a credibility-first stance. They seem to be prioritizing consistency, hitting achievable targets, rather than trying to chase short-term stock momentum. It's a very disciplined approach.
Interesting philosophy. We hit our numbers, we're on track, we're sticking to the plan.
Pretty much. And they said August results were tracking consistently with that annual guidance too. Inside and fuel volumes on track, fuel margins near 40 cents, even cheese costs were slightly favorable. So no big shifts up or down since the quarter ended, just steady execution.
Okay, so connecting this to the bigger strategy, it's still that scale and mix playbook, right?
Absolutely. Drive unit growth through building new stores and making acquisitions like CEFCO, and then leverage that strong food and beverage offering. That prepared food piece, it's their key differentiator.
It draws people in.
It draws people and gets them in the door. And hey, while they're there, they often fill up their gas tank too. It creates this perception of value that's really powerful.
That food offering really is their secret weapon. Are they still looking for more acquisitions?
Sounds like it. They mentioned ongoing M&A interest, especially smaller bolt-on deals that fit their strategy. But they're also keeping an eye out for larger opportunities too.
And they still see a room to grow.
Oh yeah. They project a runway towards maybe 3,000 stores eventually. Lots of white space, they say, in their current areas and adjacent states. So the growth story isn't over.
What's really telling, I think, is who they compare themselves to.
Right. Not just other convenience stores. They benchmark against QSR's quick service restaurants.
Like fast food chains.
Exactly. They're aiming for superior same-store sales growth, especially in that prepared food and beverage category. That ambition, wanting to be seen as more than just a gas station with snacks, that really sets them apart.
It definitely elevates their game. What about the overall economy? How's the consumer holding up from their perspective?
Seems relatively strong, actually, across different income levels. Even lower income folks are still shopping, especially grabbing those value deals in prepared foods.
Though maybe pulling back elsewhere?
Yeah, the cigarette category seems to be where that group feels the most pressure. But overall, the backdrop for staples seems pretty steady. The broader market's doing well, so it's a relatively benign environment for them. No major macro headwinds flagged.
Okay, so if the consumer is okay and the strategy is working, what are the catalysts? What could really move the needle for Casey's stock in the next few quarters?
Good question. We're definitely watching a few things. Upcoming holiday promotions, especially for pizza in Q2 and Q3. That's always a big lever for them. Then more progress on that CEFCO integration. Getting those kitchens converted, opening stores in those new southern markets. That's key to unlocking those synergies we talked about.
What else?
Well, the fuel backdrop is always a factor. Where gas prices go, where margins settle. And related to that, RINs, those renewable identification number credits. Changes there can impact fuel profitability quite a bit.
Okay, fuel, integration, anything else?
We'll obviously be listening closely to the Q2 earnings call in December for any potential updates to guidance. Maybe they'll feel more comfortable raising it then.
Maybe.
Continued M&A is always possible in this fragmented market. And fundamentally, just proving that they can sustain that inside margin at 41% or even higher, that would be significant validation.
Those are the key variables that could shift how the market sees them.
Definitely.
Okay, and now it's time for our Not Financial Advice segment. Just a reminder for everyone listening, these ideas are purely for informational and entertainment purposes.
That's right. This is absolutely not financial advice. Always, always consult with a qualified professional before making any investment decisions.
Okay, so with that important disclaimer, Casey's Q1 was strong, the guidance held steady, the stock pulled back a bit. It does create an interesting setup, doesn't it?
It really does. Intriguing.
So here's an idea for you to consider. We'll call it the confidence in conversion accumulator.
Okay, I like the name. What's the play?
Well, if you have a medium to longer time horizon, maybe you look at this post-earnings dip as an opportunity. You view management sticking to guidance not as weakness, but as that credibility-first conservatism they talked about.
So you trust the long-term story.
Exactly. The food-led growth, the acquisition synergies coming online eventually, the smart capital returns, that core strategy is still intact. So the idea is maybe you accumulate shares on any further weakness over the next quarter or so.
Betting that management keeps executing, and especially that the CEFCO integration starts showing real results.
Right. You're betting that once those Texas kitchens are fully operational and churning out that high-margin pizza, the market will eventually catch on and re-rate the stock. It's a long position, scaling in patiently.
Interesting. Okay, what's another angle?
How about something for those who maybe already own the stock or want a shorter-term income idea? Let's call this one the premium harvest covered call.
All right. Covered calls. Go on.
So if you hold Casey shares, or you're looking for income while waiting for the next catalyst, maybe that Q2 update in December, you could consider selling some out-of-the-money covered calls.
With an expiration before the next earnings call.
Exactly, before December. This strategy basically tries to monetize the current sort of sideways action, the consolidation in the stock. You collect that premium income.
Because a huge upside surprise feels unlikely right now without a guidance raise.
That's the thinking. It aims to capture value if the stock just trades sideways for a bit. Limited downside risk if it stays stable. You're essentially getting paid a little bit to wait for the next chapter in the Casey story.
Two interesting but very different ways to think about it.
Definitely food for thought. So let's wrap up this deep dive. Casey's put up a genuinely strong Q1. Excellent execution, particularly in those high-margin prepared foods. And really smart fuel management, too.
Undeniably good operational performance. But the market's immediate reaction, well, it just highlights how much Wall Street craves those constant upside surprises and guidance raises.
Which management, sticking to that credibility-first stance, chose not to deliver this time around.
Right, and those strategic initiatives, especially integrating CEFCO Fikes and doubling down on that food-led mix, those remain the critical long-term drivers.
So the big question for you to think about as you consider Casey's future is really this. How will the market ultimately balance management's discipline, maybe even conservative approach, with the very real potential for those synergies to accelerate and for inside margins to keep growing?
Yeah, what's it going to take? What catalyst, what proof point will make the market look past the steady guidance and truly reevaluate this quietly consistent but also pretty ambitious performer?
Something to ponder. That's all for today's deep dive. We hope you found it incredibly insightful.